Council, who heads the Goods and Service Tax Council, and what is its relevance in the modern day GST law. Now let us start first with the basics of GST law. So primarily under the Constitution of India, there are specific powers that has been granted to center and state to tax a specific item. For example, direct tax, the authority to charge the tax on the income is with the center. And there are specific entries in schedule of Constitution which empowers both the central government, which empowers the central government and state government to charge different types of taxes. So basically, before any tax is charged in any item, they requires power with the central government and state government through the Constitution. Therefore, there was amendment made to Constitution through one of the first constitutional amendment, which has granted the power and the state government to charge tax on goods and services or both. Okay. Primarily, since GST being an indirect tax, so what does indirect tax means? So especially indirect tax is a tax where the pinch of the tax will be faced by the ultimate person who is consuming good. Now let us understand how does it differentiate itself from a direct tax. Under direct tax, the person who earns the income will end up paying tax to the government. But under indirect tax law, there will be multiple number of persons that will be involved in the supply chain. For example, there will be a manufacturer of a good. He is selling the goods to a dealer. Dealer will be selling the goods to a wholesaler. Wholesaler will be ultimately selling the goods to a consumer or a retailer, who will end up bearing the pinch of the tax that is involved. For example, if we take so will be selling to a dealer who will be situated in different states, and that dealer will be selling it to a wholesaler. Wholesaler will sell to a retailer. Retailer will sell to the ultimate consumer, which is us, who will be bearing the tax and finally making the payment to the government. Now, GST is a destination-based indirect tax. So let us understand what does this destination-based mean. Destination-based means the state in which finally a goods or services that is consumed by the ultimate customer. That is nothing but called a destination. Suppose let us take example, Mr. A is a manufacturer of chocolates based out of Karnataka. Let us say he is located in Harohalli, industrial area. He manufactures chocolates and sells the choco flakes to a distributor who is based on Karnataka himself. Now, in this transaction, Mr. A is the originator of the supply, and Mr. B is the ultimate person who is receiving the benefits that lies with the goods. So, since Mr. B is located here in Karnataka, whatever tax Mr. A pays to the government on this supply of goods, revenue will go to the Karnataka government. Suppose in case if Mr. B is not in Karnataka and if he is based out of Maharashtra, since in this leg of transaction, since goods are being consumed in Maharashtra, revenue will go to the Maharashtra government. So GST is always a destination-based indirect tax. State in which the ultimate goods or services that are consumed, that state will get the revenue pertaining to that sale of goods. Now let us extend this example a little bit. Mr. B is a distributor located in Karnataka, and if he ultimately sells the goods to a wholesaler who is based out of Maharashtra, now Maharashtra government will get the revenue pertaining to this leg of transaction. And if this wholesaler sells a goods to the ultimate retailer or a consumer within Maharashtra, Maharashtra government will get the revenue. So indirect GST will always be a destination-based levy. State where the finally goods or services that are consumed will get the revenue. And on what it is levied. So indirect tax is levied on supply of goods or services. Now let us understand how it was different from past tax regime. Before 2017, there were multiple types of taxes that are being levied on goods and on services. Service tax was being levied on goods, especially central excise levy was there, VAT levy was there, and there were multiple laws which states have drafted themselves on which they will be charging if they are purchasing the goods from outside the state or within the state. For example, octroi was there, entry tax used to be there. Now, GST, since it is a comprehensive tax which has subsumed all the central excise, state, all different state tax, it has been a comprehensive tax which was levied on supply. So it is not a tax which gets attracted on the basis of sale. It is not a tax that gets attracted on the basis of manufacture. It is a tax that gets attracted once if there is any supply by any person to any other person. Then immediately GST gets attracted. Earlier, under the VAT, sale used to be a taxable event for VAT to be attracted, and for central excise, manufacture of goods was the trigger. Once any person manufacturing the goods, immediately central excise liability used to be casted on that regular registered person. Now, so there are multiple number of taxes that were there pre-GST regime. Now, since there was requirement of one nation, one tax, immediately in 2017, GST law was introduced by subsuming all the multiple taxes that were levied across the states and by the center. So that is one of the main reasons why GST was necessary in India. Next key item, why GST was necessary. Seamless flow of input tax credit. In earlier pre-GST regime, there were multiple types of taxes paid by different persons. Let us take an example of a dealer who is situated in Karnataka. The dealer will be purchasing the goods from manufacturer. Manufacturer, when he raises the invoice on the dealer, he will be charging two types of taxes. First one will be, since he had manufactured the goods, he will be liable to pay central excise to the government. That is the first type of tax, what he will be charging on the invoice. Second type of tax, since he is selling the goods, that will get attracted. So there used to be two types of indirect tax on the same goods. One is central excise, another one is VAT. So when the manufacturer raises the sales invoice on VAT dealer, he will be charging these two taxes. Now, when we come to the position of VAT dealer, he will be purchasing the goods, he just distributes. He does not do any additional processing or additional modification to goods. He is just a dealer who buys from a manufacturer, sells to the another person. Now, since we being in the position of VAT dealer, Karnataka VAT, we should refer to as to what type of input tax credit we will be getting. Now, I would have paid my manufacturer both central excise and in VAT. But Karnataka VAT law does not allow me input of central excise. It allows me input of only Karnataka VAT, what manufacturer had paid to the Karnataka government. Therefore, effectively, VAT dealer will have to shell out additional manufacture the goods. Therefore, cost since central excise he will not be eligible to take credit, it adds on to the product cost. Suppose if the sale price for the manufacturer is 100 rupees, he will be charging 12% becoming product cost to 112. On that they will be charging 14.5% VAT. Cost was somewhere used to be around 150 rupees, out of which the VAT dealer will be eligible to take only credit of VAT charge. Central excise effectively becomes cost to the VAT dealer. Therefore, by the time the goods reaches the ultimate customer, this kind of input tax credit, which was not permitted under caveat law, will get on adding to the product cost, thereby affecting the ultimate customer by increasing the price. Now, GST law permits such takes away such kind of stopping the input tax credit. It permits seamless flow of input tax credit, which results in reduction of cost to the ultimate consumer. For example, let us understand. In earlier regime, we used to know central excise input tax credit was not there for VAT dealer, and that's how it was resulting in increase of cost to the ultimate consumer. Now, under GST, since there is no central excise, no VAT, there is single tax, GST. So, manufacturer, when he supplies the goods to the VAT dealer, he will be charging 9% GST, CGST, 9% GST on the rate of tax applicable to the product. Now, when the dealer gets the invoice from the manufacturer, he will be selling it to wholesaler. When at the time of he raising the wholesaler, he will be charging again CGST, SGST if the wholesaler is based out of Karnataka. So the VAT dealer will be eligible to claim whatever tax that was charged by the manufacturer on the invoice raised by him. So thereby effectively whatever GST that was collected by the manufacturer, it will be available to the VAT dealer as an input tax credit, which he will be eligible to offset completely against the tax what he is going to charge on the sale, resulting in reduction of product cost to the ultimate consumer. This is one of the biggest reason why GST was necessary in India. So primarily, France was the first country who has implemented this GST law way back in 1954. Subsequently, many countries have followed France model. But in India, we have something called as dual taxation model, wherein center was also having the power to charge the tax, state also was having the power to charge the tax. It is dual model. It is primarily there in Canada and Brazil. Many other European countries, they have adopted single type taxation, wherein their central authority is goods services. But here in India, both center together with the state has the power to tax on the services and goods. So we had adopted Canadian model of GST. We had brought this concept from. Now there are three legislations which are primarily driving the GST law. One thing is Central Goods and Services Tax Act. Next one is State Goods and Services Tax Act. In case of Union Territory like Andaman, Nicobar, Lakshadweep, it will be Union Territory Goods and Services Tax Act. And the third one is Integrated Goods and Services Tax Act. This CGST Act gives the power to the central government to charge tax on goods and services. Respective state. For Karnataka, it will be Karnataka Goods and Services Tax Act. For Maharashtra, it will be Maharashtra Goods and Services Tax Act. So it will be respective state will be enacting their own GST Act for that state. So SGST Act of respective state will empower the state government to charge tax on goods and services or both. This Integrated Goods and Services Tax Act has the power with the central government to levy tax on interstate supply of goods. That we will get to know later. What does intrastate supply means? What does interstate supply means? So integrated tax has the power on central government itself. But once the revenue is collected by the central government in the form of IGST, subsequently it will be apportioned government, state government. 50% of the revenue will go to central government, 50% will go to the state government where the goods are consumed. I hope everyone is able to follow.
Yes, sir.
Okay, thank you. Now let us move on to the definition of supply. See, for every tax to be charged, there should be something called as taxable event. Example, in case of income tax, a person earning income is the taxable event. So the time when he earns income, tax will liability to pay to the government arises immediately. Same in the way, for GST to be attracted, there should be a taxable event. So under goods and services tax law, supply is a taxable event. The time in which any person initiates supply of goods or services, immediately the liability to pay GST arises. Now, all this supply, law has given a specific definition to supply. Always remember the definition what I'm going to speak here is an inclusive definition of supply. That means everything, anything can be supply. For purpose of illustration of that, law has given specific list of items what amounts to supply. Now let us understand what are all the definition the law has provided as supply is concerned. The term supply includes sale, exchange, or barter, or license. Supply includes rental, lease, disposal. So supply will not always be restricted between these four legs of the transaction. It can include anything else. For example, if you refer to Schedule 1 of Central Goods and Services Tax, are you able to hear me now properly?
So voice was breaking.
So what I was telling is, whatever four legs of transaction that are that have been put here, right? Supply is
Om Prakash sir, actually
Yes, sir.
the voice audio is not very much clear. So we tried to stop your video also, but in spite of that, it is not very much clear.
Is it okay now, sir? Because
that's
ಇಲ್ಲ ಮಧ್ಯದಲ್ಲಿ ಸ್ವಲ್ಪ ಡಿಸ್ಟರ್ಬೆನ್ಸ್ ಆಗ್ತಾ ಇದೆ ಯಾಕಂದ್ರೆ ಮೆಸೇಜ್ ಕೂಡ ಹಾಕ್ತಾ ಇದ್ದಾರೆ ವಾಯ್ಸ್ ಕ್ಲಿಯರ್
ಬೆಸ್ಟ್ ಪ್ಲೇಸ್ ಅಲ್ಲಿ ಇರಿ ಸರ್. ಅದೇ ಅಂದ್ರೆ ರಿನ್ಯೂವಲ್ ಪ್ಲೇಸ್ ಅಂತ ಸಮಸ್ಯೆ ಹೇಳಿದ್ರೆ ಸರ್, ನೆಟ್ವರ್ಕ್ ಇಲ್ಲ ಅಂತ.
ಹೌದು,
ಅದೇ ಕರೆಕ್ಟ್. ನಾನು ಕಾಮ್ ಆಗಿರೋ ರೂಮ್ ಅಲ್ಲೇ ಕೂತ್ಕೊಂಡಿದ್ದೀನಿ, ಯಾರು ಇಲ್ಲ. ಐ ಥಿಂಕ್ ಇಸ್ ಇಟ್ ಓಕೆ ನೌ?
ದಟ್ಸ್ ನೌ ಬೆಟರ್ ಸರ್.
ಬೆಟರ್. ನನ್ನ ಫ್ಯಾನ್ ಸ್ವಿಚ್ ಆಫ್.
Girish, see
Is
if
it
you
okay
can
now?
something. Girish, try to.
Yes, madam. Only our network problem is there.
Okay.
Go ahead, sir.
Shall we continue? Okay.
Yeah, please.
So let me repeat.
Please.
So primarily, law has given an inclusive definition of supply. Means everything under the sun can be a supply. But just for the sake of understanding and illustrating to the taxpayers and stakeholders of GST law, it has provided 5 to 6 items which can be termed as supply. So let us understand this each item one by one. Sale. So any person selling the goods to any other person will become a supply, which is very easy to understand. Now, what does exchange means? So exchange means a transaction which involves one person giving the goods and taking back another good which is in condition. For example, if you a dealer showroom, exchange your old car and get a new car exchange. So that nothing. So if you are though you are not getting sale consideration over there, consideration is being received in the form of in kind. So therefore, exchange is also a supply. This is very prevalent in the earlier days, wherein rupee was not the denomination of exchange. So earlier people used to exchange wheat for getting bread. People used to exchange wheat for getting pair of shoes. So that is barter. So barter is also term included as part of supply. Now transfer. Example of transfer could be if I had developed a software program and I am owning the intellectual property right assigned to that software. Now, if I sell my intellectual property right or transfer my intellectual property right, that will be termed as transfer. Now, if I license a intellectual property for using it in course of business, that is nothing but called as licensing. Now, renting of a immovable property will also be treated as supply. Leasing of immovable property will also be treated. Disposal of a business asset. For example, if you are writing off inventory since it has become unusable, that also will be treated as supply. So, supply itself is not restricted with these 4 items. It is much more than this. For example, if you can refer to Schedule 1, it has got 4 items within itself. Even though such items which do not qualify supply, still they will be treated as supply for the purpose of GST. And this supply should always be coupled with consideration. Consideration means getting selling the goods, or else in case of exchange, getting the old car, selling the new car, difference amount, the dealer will be collecting in cash. That is nothing but consideration. So supply should always be coupled with consideration. Otherwise, it cannot be a supply. If there is no consideration, it cannot be a supply. Clear? This should also be made in course of business or in furtherance of business. Suppose, take an example, an individual selling goods, not in course of business. We had some old material, old scrap which is being, if he sells the goods, whether that become a supply, just by referring to first limb of the transaction, it will be treated as supply since he is selling the good. But it is with the for the purpose of consideration itself. He will be getting the money from the person who is purchasing the goods. But is it in course of his business? No. Since there were scrap items that were left at his home, he is selling them. Since it is not in course of his business or in furtherance of his business, it will not be treated as supply. So essentially, for any transaction to qualify as supply, it should form part of these four limbs, and it should be coupled with consideration, and it should be backed up by in course of business or in furtherance of business. Only if these three items are there in a specific transaction, then only such transaction will amount to supply. Otherwise, it will not be a supply. GST will not get attracted at all. Is it clear? So you need to be very, very clear about supply for you to understand the remaining portions of the law. Is it clear for everyone?
Yes, sir.
Okay. Now let us understand supply is of two types. So primarily in a transaction, if the item being sold or if the service being sold is a single item, then there will not be complications for us to decide upon what type of tax to be paid and what is the rate of tax to be paid. But if the supply involves one or more items, suppose for example, if you are going to a car service center, you got your car repaired and he will be giving a one big lengthy bill, which has got multiple types of items. First item might be oil change, second item will be labor charges for repairing, third item, depending upon the type of repairs you had done, there will be different items that will be charged to you. Clear? So in such cases where there is multiple types of items that are sold in the sale invoice, there comes the complication. Which rate of tax I need to take? Whether do I need to take tax rate applicable for the service? Whether do I need to take tax rate applicable for the oil? Whether do I need to take tax rate applicable for the type? So there confusion arises. So GST law has got a provision which causes such complications. One thing is something called as composite supply and mixed supply. Now let us understand what does this composite supply means. Composite supply is a supply which has got one or more taxable supplies. Remember, taxable supplies should be there, which are naturally bundled in course of business. Now, what does this naturally bundling? So naturally bundled means the items that are being sold in the market, if it has got coupled with any other item. For example, sale of laptop together with the laptop bag. It is very much prevalent practice in the market. Same way, if you are selling the goods to a party located outside India. Now, since the goods will be passing through ocean and all, there will be much risk attached to the goods being lost. So if you are taking an insurance, it's very much prevalent practice. If you are providing transportation services together with selling the goods, that is also something called as composite supply. It should be always naturally bundled, which is a prevalent practice in the market. But suppose if you take another example wherein the person selling the goods, suppose a person who is selling soap, if he's selling a pen along with that soap, then that is not naturally bundled. It is not a prevalent practice. Unless it is widely accepted in the industry and it is widely being done among the industry players, then only it will be called as a composite supply. Something which is not composite supply, which has got two supplies, will automatically become a mixed supply. Now, in case of composite supply, what is the type of tax? What is the rate of tax I need to charge? Whether do I need to charge the rate applicable on the laptop bag, or whether do I need to charge tax rates applicable on the laptop? In case of composite supply, tax rate applicable to the principal supply will apply to the whole transaction. Now, let's take the same example of laptop sale. Hello?
Yes,
Hello?
Hello, Om Prakash.
Everyone is able to hear me?
Yeah,
Sir,
voice
everyone
break
is able to
ಆಗ್ತದೆ.
hear me?
Only we can hear a video off ಮಾಡ್ಬಿಡಿ. We can hear your voice.
Okay, I'll stop the video temporarily,
Yeah,
sir. I think that is consuming more data.
Yeah,
Yes,
we have
yes,
stopped
yes.
the video.
Sir, you can focus on him only as he's
Yeah.
speaking, right?
Correct.
That
correct.
is a good idea.
ಹೌದು.
ಅವ್ರ ಮೇಲೆ ಫೋಕಸ್ ಮಾಡಿ ಕ್ಯಾಮರಾ.
Okay, let us run. So in case of composite supply, always tax applicable on the principal supply. Now let us take example of the laptop sale. Now whenever you go to any laptop center where you wanted to purchase a laptop, primarily you are going to that laptop center for purchasing the laptop, not the laptop, correct? So here in this composite supply transaction, principal sale is of laptop only. Bag, since out of their marketing activity, they are additionally selling you the bag at a discounted price. Therefore, whatever tax rate applicable to the laptop, same amount of tax rate will be charged on laptop bag also. For example, if the laptop is costing you 50,000 rupees and the rate of tax applicable on a computer is 18%. And if the laptop bag is costing you 1,000 rupees, though the tax rate on laptop bag is 12% or 5%, but still tax rate applicable on the computer, same tax rate will apply on laptop bag also. Therefore, effectively, you will end up paying 18% on 1,000 rupees. Even if it is 28% also, still 18% would apply. Even if it is 5% also, 18% would apply. That is how the items under composite supply will be taxed. Now, something which is not a composite supply will become a mixed supply. Mixed supply means which is not naturally bundled. In case of composite supply, we understood that two items should be naturally bundled in course of business. But if it is not a natural bundling, then automatically it will become mixed supply, wherein two or more items are involved. But especially always remember the difference between composite supply and mixed supply. In composite supply, both these supplies should be taxable supplies. Suppose, let us take another example where you are purchasing dry fruits together with fruit as a single package. Now, rate of tax applicable on dry fruits is around 5%, but on the fruits, if you are purchasing from a shop, it will be zero rated supply since it is agricultural produce without any packaging. Therefore, since these two will not be naturally bundled in course of business, but one of them is a non-taxable supply, which is agricultural produce, then automatically it does not qualify as composite supply. It will always form part of mixed supply. In mixed supply, the two supplies which are involved need not be taxable. One can be a taxable supply, another one can be an exempt supply also. Always remember this definition, very, very important when you're judging whether a supply amounts to a composite supply or mixed supply. Because if you are judging a supply wrongly, it will impact the tax amount what you are paying to the government. Ultimately, there will be scrutiny from the GST department. Subsequently, they will be charging you interest and penalty. So judging a supply is very, very important. In case of mixed supply, the tax rate applicable, highest tax rate applicable on a specific item will apply to the entire supply. Now let us take example of packaged foods containing sweets, dry fruits, chocolates. Now rate of tax, assume the rate of tax applicable on sweets is 18%, on dry fruits 5%. Since sweets and dry fruits are being sold in a single packet, rate of tax applicable on the sweets is 18%. rate of tax applicable on the dry fruits is 5%. Therefore, highest rate of 18% will be charged on dry fruits also. So in case of mixed supply, which is not naturally bundled in course of business, highest rate goods, whatever that is involved in the transaction, such highest rate will apply for remaining items also. If you are paying 18%, 18% will apply for remaining items also. If it is high 28% rate items are there, 28% will apply for remaining items too. So that is the difference between composite supply and mixed supply. Is it clear for everyone? Any questions?
So no questions, but your slide is not visible, sir.
Slide is not visible.
So we cannot see the screen.
1 minute.
Sir, share screen has been.
So please share the
I think
slide
someone
itself.
disabled it suddenly. It was visible then.
ಈಗ ಕಾಣ್ತಾ ಇದೆ.
Okay, 1 minute, sir.
ಇದನ್ನ
Is it
ಹಾಕಿದ್ರೆ
okay now?
ಏನಾದ್ರು ವಾಯ್ಸ್ ಏನ್ ಬ್ರೇಕ್ ಆಗುತ್ತಾ ಹಾಕಿದ್ರೆ ಇದನ್ನ? ನಥಿಂಗ್ ಅಲ್ಲ?
ಇಲ್ಲ. As long as video is not there, I think it should get through, sir.
Okay.
Yes, sir. Now it's visible.
Now it's so. I hope everyone understood the difference between composite supply and mixed supply.
Yes, sir.
So composite supply, natural bundling, plus both the supplies should whatever supplies that are involved in the transaction should be taxable, and it should be naturally bundled in course of business. And in case of mixed supply, it need not be naturally bundled. Plus, it can one of the supplies can be exempted supply also. And in case of composite supply, principal item tax rate will apply to remaining items. In case of mixed supply, whichever is the highest rated taxable supply will apply to remaining items in the supply. Now let's understand the concept of interstate supply and intrastate supply. This is also very key item that needs to be necessarily understood, because this is the item which will help you in deciding what type of tax to be charged on the sale. Suppose if you are selling a goods to a dealer who is based out in Karnataka, whether do you need to charge CGST, SGST or IGST or CGST, UTGST. So let us understand interstate supply and intrastate supply. Interstate supply is defined in the Central Goods and Services Tax Act, which means that if the seller and buyer is located in the same state or same union territory, then it will be termed as intrastate supply. Suppose Mr. A, manufacturer, located in Harohalli, Mr. B, dealer, located in Bangalore. Since Harohalli and Bangalore is located within the state of Karnataka, it will be treated as intrastate supply. So when a supply becomes an intrastate supply, automatically type of tax to be paid on that transaction will be CGST plus SGST. CGST will be charged by the central government through CGST Act. SGST will be charged by Karnataka government through Karnataka SGST Act. Now, suppose if a person, Mr. A, who is a manufacturer located in Harohalli, he has a dealer in Maharashtra. Supplier is located in one state, buyer is located in another state. Automatically, this kind of transaction will become interstate supply, which is defined in the Integrated Goods and Services Tax Act. So once it becomes an interstate supply, type of tax that needs to be charged on supply will automatically become IGST. As I said earlier, this IGST will be split between central government and state government in 50-50 portion. 50% will go to central government, remaining 50% will go to the state government where the service will be consumed. Clear? So if it is intrastate supply, CGST, SGST will apply, center will charge CGST, state will charge SGST. If it is case of interstate supply, center will charge a tax in the form of IGST, which will be subsequently be divided among central government and state government. 50-50 they will be sharing. Clear? What if I sell goods outside India? Till now we had discussed that if it is within state sale, intrastate. If it is outside the state sale, it will be interstate. Even if you are selling goods to a customer located outside India also, still it is deemed to be included as part of interstate supply only. So interstate supply includes supply between two different states. It includes supplies exported outside India or imported into India. Still it will be treated as interstate supply. Clear?
Yes, sir. Proceed.
Okay. Now let us understand the key pillars of GST law. So these are the 4 key items which will decide a transaction. What is the type of tax to be paid? What is the rate of tax to be paid? On what value of the transaction the tax needs to be paid? And at what point in time the seller needs to pay the tax? So pillars of GST: time of supply, supply. Third one is taxability and rate of tax. Fourth one is value of supply. Now, what does this time of supply means? Time of supply means the point in time at which the tax liability arises on the transaction. Now, let us understand. Mr. A, who is a manufacturer in Arohali, sells goods to the dealer in Maharashtra. Now, there will be, in one single transaction, there will be multiple events. First event, it will happen, dealer will raise a purchase order to the manufacturer. Now, confusion will start whether at the time of raising the purchase order, do I need to pay tax, or whether manufacturer A raising the invoice, that is the point in time when I need to pay tax, or when Mr. B receives the goods, whether at that point in time do I need to pay the tax. So there will be confusion at point in time. I will be legally liable to pay tax to the government. So time of supply rules in CGST Act and SGST Act will help us to understand at what point in time of the transaction the legal liability to pay tax on the supply arises on the registered person. Now, what does the supply means? Till now, we had understood that GST is a destination-based indirect tax. I mean to say, state where the goods or services are consumed, that state will get the revenue pertaining to the transaction. Correct? Same way, how do we decide which is the destination? Because GST law specifically provides for rules which helps us in deciding which state shall be treated as the state which is consuming the goods or services. It has got its own set of rules, both for goods and for services, which helps us in deciding what is the place of supply for a specific transaction. Now, taxability and tax. So, the law specifically provides exemptions for certain categories of supplies through notifications, which we have notified in all the 3 acts. It shall be notified under CGST Act, it shall be notified under SGST, together with under IGST. So we need to keep on checking before we conclude whether a supply is taxable or not. We need to check each and every notification which has got exemption or taxability of a specific goods or services. Now, once we conclude that a service is taxable or exempt, then immediately question will come: what is the rate of tax that we need to charge on the goods? So, Central Goods and Services Tax Act, SGST Act, and IGST Act has got schedules which prescribe different rates of tax for each kind of goods or services. Primarily, India has adopted 4 kinds of tax, 4 tax rates: 5%, 12%, 18%, and 28%. And there are other tax rates such as 0.1%, which is levied on deemed supplies and all. Now, this 5% is the comprehensive rate. If it has to be divided between CGST and SGST, CGST will become 2.5%, SGST will become 2.5%. And if it goes to 18%, 9% GST, 9% is GST. And if it goes to 28%, 14% C, 14% S will be charged. In addition to these tax rate, there will be additional compensation cess that shall be levied on specific type of goods. For example, if you are drinking Coca-Cola, you will end up paying effectively GST of 43%. 28% actual tax rate plus additional compensation cess of 15% will be levied on Coca-Cola, especially this aerated soft drinks, pan masala, tobacco products. Primarily under the taxation language, these kind of goods are referred to as sin goods. SIN, sin goods. All these goods will be subjected to highest rate of GST, which is 43%. So next, moving on to the value of supply. So valuation rules in GST law helps us to understand on what value do I need to charge my tax and collect it from the value. There are specific rules which GST law prescribes as to how we need to estimate value of a specific transaction on which we need to charge the tax. Now let us understand one by one in detailed manner. First, on to time of supply. So as we had understood, time of supply rule helps us determine at what point in time in the transaction do I need to pay tax to the government. Now it has got its own rules for separately for goods. It has got separate rules services. In case of goods, time of supply will be earlier of date of invoice. DOI means date of invoice. DOP means date of receipt of payment by the supplier of goods. Earliest of these two dates will be the time of supply. For example, let us take an example of a dealer who is based out of Bihar. Now he sells the goods to a dealer based out of Maharashtra. Once Mr. A raises the invoice on 15th March, assume, automatically 15th March will become the trigger which will on the day liability on Mr. A, who is based out of Bihar, will arise to pay the tax. But practically, this does not work this way. So the liability on the manufacturer or the supplier arises on the date of invoice, but actual payment of tax to the government will happen on subsequent month 20th. Suppose if the invoice is raised on 15th March 2021, tax actual payment to the government will happen on 20th April only. Just for the purpose of administrative, that is how the structuring has been done practically. But as far as law is concerned, Mr. A is legally liable to pay tax to the government on 15th March itself, not on 20th March. But just for the purpose of administrative convenience, the government is permitting and giving the time to Mr. A till 20th of subsequent month to pay tax to the government. So in case of goods, date of invoice or date of receipt of payment by the supplier, earliest of these two dates will become the time of supply. Now let us understand how does it work for goods or services. Goods we are very clear because there will not be any other ambiguity. Now in case of services, there are three specific dates what GST law prescribes. Earliest of these three dates will become the time of supply for services. First one is date of invoice. Same way like how goods had. Next, DOP means date of receipt of payment. Next, date of service. Date of service means date of completion of service. Now, especially in case of services, there are three dates involved. Earliest of these three dates will automatically become the time of supply in case of services. Now, and is there any specific rule which tells us that you have to raise invoice on a specific date? Under GST law, for goods, at the time of you moving the goods out of your factory to the dealer's office, you should raise invoice. There is a specific rule which tells that at the time of moving the goods, you should carry an invoice. Otherwise, if you move the invoice, without carrying invoice, right? There will be additional implications like in the penalty being check post. So the time of movement of goods, you should raise invoice. That is the date of invoice. Now for services, law gives certain amount of relief. So once you complete service, you can raise invoice, or else you will be permitted with a time period of 30 days. Suppose if you are completing the service on 15th January 2021. Let us take an example of a software consultant who is rendering software services to a software company. He completed his service on 15th January 2021. He can raise on 15th January, discharge the tax, leave the company. Otherwise, he has got the time period of 30 days, which ends on 14th February 2021. From 15th January till 14th February, at any in between these two dates, at any point in time, he can raise the invoice, charge the tax, collect the tax. But if he is raising beyond 14th February, then automatically, since he is belatedly raising the invoice, he will be liable to pay interest to the government, because legally he was liable to pay tax to the government on 14th itself, but he is raising the invoice on 16th February and making the tax payment. It is wrong. So therefore, times of the rule us in deciding at what point in time the legal liability to pay the tax to the government arises on the service provider or seller of goods. Now there is specific rules that are specified for different kinds of services. In case of reverse charge mechanism, that we'll understand separately, that I'll explain separately. Now let us understand what does this place of supply means. Supply rules in GST law helps us to determine the place where goods or services are consumed in accordance with the GST law. So practically, though the goods are consumed in a specific state, but GST law specifically contains rules which we need to follow for us to decide where the services are consumed or goods are consumed in accordance with GST law. So IGST law contains the place of supply rule. For you to decide what is the place of supply for a specific transaction, you must refer to IGST Act. In case of time of supply, respective state goods and services tax act plus central CGST Act will contain the specific rule. And always remember, let me clarify, whatever provisions that are there in central goods and services tax act, it will be completely mirrored in state goods and services tax also. SGST is nothing but copy paste of our entire CGST provision together with its rules. There will not be any changes. So once you read any provision in central goods and services tax and conclude on time of supply, you need not go again to respective state goods and services tax act, because it is complete replica of CGST Act. Okay. IGST Act provides for place of supply rules for both goods and services. In case of goods which are involving movement of goods, which involves movement. Suppose let us take example of our original example, Mr. A, who is a manufacturer sitting in Harohalli. Mr. B is a dealer sitting in Maharashtra. Since when sells the goods to Mr. B, goods will need to move from Karnataka to Maharashtra. So in case of all kinds of goods which needs movement from one place to another, place of supply will be location of the goods at the time of delivery to the customer. Suppose Mr. A is transporting the goods from Karnataka to Maharashtra. At the time of delivery to Mr. B, location of the goods will be in Maharashtra. So automatically place of supply for that transaction will become Maharashtra. Automatically, once place of supply is lying in another state, Mr. A is sitting in Karnataka, place of supply is in Maharashtra, it will become an interstate supply on which IGST will be levied. Clear? So wherever there is movement of goods from one state to another state, at the time of delivery is that time. At the time of delivery, we need to check where is the location of goods. Automatically, such location of goods will be the place of If it is Maharashtra, it will become Maharashtra. Suppose, let us take another example. 3 people are there. Mr. A based in Karnataka, Mr. B based in Maharashtra, Mr. C sitting in Gujarat. Now, Mr. B is purchasing the goods from Mr. A. Mr. C is the person who is sitting in Gujarat. Mr. B directs A that, boss, you don't send me the goods directly to Maharashtra, you send the goods to Gujarat with to C directly. So GST law has got a specific rule which helps us to decide in this where tripartite scenario, it helps us to decide what is the place of supply. Since Mr. B is directing Mr. A to send the goods directly from Karnataka to Gujarat, location of Mr. B will be the place of supply. So the goods are actually not reaching Maharashtra. But if we go to our basic principle of destination-based levy, in this tripartite transaction, goods are going directly to Gujarat. If we don't refer to this rule, we will end up in concluding that since goods are being delivered to Mr. C, we will conclude that supply will be Gujarat. We will be charging IGST only. So once IGST is charged, money will go to central government 50%, remaining 50% will go to Gujarat government. But GST law specifically gives a rule which helps us to decide what is the place of supply in tripartite transaction where 3 parties are involved. In this example where there are 3 parties, Mr. A in Karnataka, B in Maharashtra, C in Gujarat, if B is directing Mr. A to send the goods directly to dealer in Gujarat, place of supply in such cases will be location of Mr. B. Though the goods are not specifically reaching Maharashtra location, still GST law tells us that place of supply in this tripartite transaction will always be the location of person who is directing the goods. Since Mr. B is directing the goods in our case, location of Mr. B, which is Maharashtra, Maharashtra will become the place of supply. And ideally, we will be charging IGST, which will be now let us understand what does place of supply rule in case of services. In case of services, where service provider is sitting in Karnataka, and if the service receiver is sitting in Karnataka, location of the service recipient will always be the place of supply in case of services. Mr. A is sitting in India, Karnataka. Mr. B is also sitting in Karnataka. Means automatically location of Mr. B, which is Karnataka, will become place of supply, thereby attracting CGST plus SGST. Suppose if Mr. B is sitting in Maharashtra, it will become an interstate supply, attracting IGST levy. So please do remember, in case of goods, it will be the location of goods at the time of delivery to the recipient will be the place of supply. In case of services, location of the services recipient is the place of supply. Whether this location of services generic rule of location of services recipient will apply for all services? No. GST law has carved out specifically for 13 kinds of services where this generic rule of location of service recipient does not apply. For example, let us not get into those 13 services. I'll give you 2 to 3 examples. In case of immovable property, we understood that renting of an immovable property will also be covered in the definition of supply in the first supply discussion. Now, in case of immovable property renting, GST law typically provides that place of supply in case of services will not be location of services recipient. Let us understand this through an example. Mr. A is a owner of building in Karnataka. He has a building in Richmond town. He has rented out to a company based out of Maharashtra. If we follow the generic rule, since the customer is located in Maharashtra, we will conclude that it is a interstate supply. We will charge IGST, we will pay the tax. But in case of immovable property services, specifically the GST law provides for place of supply rule. In case of immovable property, it will be the location of immovable property that will become place of supply, but not the customer's location. Since location of immovable property is in Karnataka, it will become intrastate supply. But in generic rule, customer's place would become the place of supply. But in case of immovable property, since the GST law specifically provides for such rule, location of immovable property will become the place of supply, which in our case will become the Richmond town. It will become an Karnataka supply, which is an intrastate supply. So Mr. A on the tax invoice, what he is going to issue to Mr. B, he will be charging CGST, SGST only, but not IGST. Like that, immovable property, different place of supply rule is there. For beautician treatment, there is separate place of rule. For telecommunication services, there is separate place of supply rule. For event management, separate place of supply rule. So for different kinds of, for generic services, always it will be location of customer, but there are specific, almost 13 services are there, which has got different place of supply other than location of the customer. Clear?
Yes, sir.
Yeah.
Hello.
Next
Om
one.
Prakash,
Yes, sir.
how much time will you need for concluding, sir?
It will take, sir, 20-25 minutes it will take. I'll run through little fastly. I think I'm taking time.
Yeah.
I'll run fast. Now, the next section, which deals with taxability and rate of tax. So, for us to understand whether a supply is taxable or not, we need to refer to all three acts and subsequent corresponding notifications issued under each act. And we need to refer to a rate schedule for us to understand what is the rate of tax applicable for the specific goods or services. Now, coming on to value of supply. So GST law has got specific valuation rules. Always transaction value is the amount on which tax will be levied. Transaction value is nothing but sale price between a willing buyer and willing seller. If there are two persons involved in a specific sale transaction, the arm's length price between the two will be the value on which tax needs to be charged. Suppose if there is any incidental charging, let us take an example of a person selling the goods from Karnataka to Maharashtra. If he is providing transportation services also from Karnataka to Maharashtra, and if he is charging as part of same single invoice, then automatically this transportation charges should also be included as part of supply, and on total value we need to charge tax, because all the incidental expenses that the seller has incurred with respect to the same supply will need to be included as part of value of supply. Otherwise, if you charge tax only on the sale price and end up paying taxes, at the time of assessment, tax officer will tell that all the incidental, since transaction value includes all the incidental expenses pertaining to the supply, he will end up paying tax on transportation charges too, together with interest and penalty. Clear? So it has got specific rules how we need to arrive at value of a supply in case of transaction between two unrelated persons. In case of related persons, how that transaction value needs to be ascertained. Clear?
Yes, sir.
Yeah. Now let us get into most interesting aspect with respect to when should a person obtain registration under Goods and Services Tax Act. So Goods and Services Tax Act, earlier it never used to be a PAN-based registration. So there used to be multiple registration for a single person. Now in the GST law, the registration is always PAN-based. So a person can apply only one single registration in a state. He can have multiple registrations in different states, but in one state, one registration is only permitted. There are though the law provides for two registration within separate state, let us not get into that. So it is always a single registration in a single state, which is PAN-based. So a person need to obtain registration if his aggregate turnover exceeds limit of 20 lakhs, 10 lakhs in case of special category states. Now, what does the term aggregate turnover means? So till now we had been understanding that supply valuation rules, time of supply rules. Now once if we had to find out whether do I need to specifically register under GST law or not, I need to understand the term aggregate turnover. Aggregate turnover means taxable value of all supplies, whether they are taxable or not. Transaction value of all supplies, whether they are taxable supplies or exempted supplies. So we should include value of taxable supplies plus value of exempt supplies for us to arrive at aggregate turnover. Now let us take an example of a Kirana store guy who is selling non-taxable goods as well as taxable goods. If his turnover during the previous financial year, taxable goods is 5 lakhs, exempted goods is 21 lakhs. Total turnover, aggregate turnover should include both the turnover of taxable goods plus turnover of exempted goods also. So 5 plus 21 will automatically cross 20 lakhs. Therefore, he needs to mandatorily register under the GST law. And in case of special category states, only 3 states are specifically casted with the special category status. If the dealer is located out of Mizoram or Manipur or Nagaland, then such limit will become 10 lakh rupees. It will not be 20 lakhs. So once it crosses limit of 10 lakhs, automatically the registration needs to be taken. Now GST law provides 4 types of registrations. First one is regular registration. Second one is casual taxable person registration. Third one is non-resident taxable person. Fourth one is composition registration. Now let us understand each of these registrations in detail one by one. Regular registration. Regular registration will, whenever you apply for any registration, by default, it will be a regular registration only. Once you cross the limit of 20 lakhs, you will get regular registration and you will be eligible to make supply of goods and services, and you will be eligible to issue tax invoice to your customer under regular registration. Casual taxable person is a person who occasionally undertakes supply of goods and services, but does not have fixed place of business in that specific state. Now let us understand this through an example. I have purchased a machinery from a person based out of Gujarat. Install the machinery in my factory in Karnataka. Use the machinery. So assume there is some repair to the machinery. Now none of the persons are available in Karnataka to repair that machinery. I need to call a person from that Gujarat to get the machinery repaired. Now this Gujarat guy who is rendering the services in Karnataka will not be having registration because he does not supply the goods or services from Karnataka. Therefore, he did not obtain any registration. He has got registration only in Gujarat. Since he is providing the services in Karnataka state, he will be liable to take the registration under GST law since his turnover is already exceeding 20 lakhs in Gujarat state. And one trigger here, this 20 lakhs turnover, it is not each individual state wise. It is pan-India. Suppose if you take registration in Gujarat, if your turnover is crossing 20 lakhs in Gujarat, automatically if you want to register in Karnataka, though your sales does not exceed 20 lakhs, you will still be liable to take registration. So it is a pan-India level. So once you have turnover in different states, you should sum up turnovers of all the states to verify whether you need to take registration in specific state or not. So let's continue that example. Mr. A has come to the factory to repair that machinery. Since his turnover in Gujarat already exceeds 20 lakhs, since he is supplying goods and services from the state of Karnataka, he is able to take registration in Karnataka. So if he takes a regular registration, he will have to file monthly returns. He will have to make taxes payment on a monthly basis or quarterly basis depending upon turnover. To avoid this multiple compliance, since he is rendering the services only one time, to avoid this multiple compliances, the law has provided this specific registration. This casual taxable person registration who occasionally undertakes, not frequently. and this registration will be valid only for a period of 90 days. Beyond 90 days, this registration shall not be valid at all. But with the specific permission of the commissioner, this 90 days can further be extended to additional time period of 90 days. So in total, it will be 180 days. Beyond 180 days, you should not provide any services in the state of Karnataka. If you want to provide, obtain regular registration, file the returns on a monthly basis. But if you are taking registration as a casual taxable person, then you can provide services up to 90 days only. Now let's understand what does this non-resident taxable person means. He is a person who occasionally undertakes supply of goods and services, but he will not be having fixed place of business in entire India. In case of casual taxable person, the person who is duly applying for registration, he can have elsewhere in India. But in case of non-resident taxable person, he should not have fixed place of business anywhere in India. So a non-resident person who is coming to India for servicing the machinery will not be having the fixed place of business anywhere in entire India. Then he is eligible to apply for non-resident taxable person registration. I hope everyone is clear with the difference between casual taxable person and non-resident taxable person. Let us repeat. Casual taxable person, if he is having registration elsewhere in India, he can apply for casual taxable person registration. If there is no earlier registration, then one has to apply for non-resident taxable person registration. Next, composition registration. This is also part of subset of regular registration only, which is granted to a person with a turnover of up to 1.5 crores only. So at the time of you applying for the registration under GST law, you will apply as part of regular registration only. But since your turnover is less than 1.5 crore, you will be eligible to shift yourself to composition tax regime under GST law. That we will discuss in detail subsequently. Now, when I take, what is the benefits of taking registration and as regular? I will be eligible to issue tax invoice to my customer, and my customer will be eligible to take in tax credit on the tax what they charge on supply. In case of composition registration person, he will not be eligible to issue tax invoice. At the time of raising invoice, we will be specifically mentioning the invoice called as tax invoice. At the time of you selling the goods, you raise a tax invoice. On the basis of such a tax invoice, your customer will be taking input tax credit. But in case of composition registration, I will not be eligible to issue tax invoice. I will be issuing only something called as bill of supply. Since bill of supply is not a valid document for the customer to take input tax credit, he will not be eligible to take input tax credit under composition registration. Now let us get into different types of returns. What needs to be filed under the GST law? So primarily there are two types of registrations. One is regular registration, which has got a set of regular casual taxable person, non-resident taxable person, composition taxable person is a separate category. So returns can be filed either on quarterly basis or monthly basis. To reduce complex burden for small taxpayers, GST has got both monthly returns and quarterly returns. Person who has got a turnover of more than 5 crores, they will be required to file on a monthly basis. Persons with turnover of up to 5 crores, they will be able to file their returns on a quarterly basis. Always remember again, how do we calculate turnover of 5 crores? Aggregate turnover. Like earlier we had discussed, aggregate turnover is equal to value of taxable supplies plus value of exempted supplies plus value of research supplies also. So when you calculate the threshold limit of 5 crores, you must mandatorily include exempt supplies value. Then decide whether are you eligible for monthly scheme or whether you are eligible for quarter scheme. Now let us understand what is the type of return, what a regular taxpayer files on a monthly basis. First is Form GST. Form GST1 is nothing but return of all outward supplies what a registered person made during the month. Suppose within the month, if I am making 10 invoices of taxable supplies, 10 invoices of exempt supplies, I should disclose both the value taxable supplies plus exempt supplies in my GSTR1. It has got its own subset. So if you actually see from GSTR1, it has got B2B, B2C. B2B means if I am selling to a subsequent B2B, business to business transaction, then it is a B2B transaction. If I am selling to ultimate customer, it is called.
Hello. Hello. Hello.
Hello.
Continue.
Speak,
Continue.
sir, no problem.
Continue.
Okay, sir. You can-
Sir, I'm continuing.
Om Prakash, please continue.
So GSTR1 is the return of all outward sales what a person makes during the specific month, and it needs to be filed on or before 10th of every month. So if you are making sales in the month of March, return for the month of March needs to be filed on 10th April. GSTR1 return. Now there is another return, something called as Form GSTR2A, return all inward supplies. This is a dynamic document. Now in the returns mechanism is designed in such a way that when you are selling the goods to a specific party, whatever sales you had made to a specific party, that customer will be eligible to see all the sales made to him by different vendors in his Form GSTR2A. Let us understand this through an example. Mr. A sitting in Karnataka made a sale to Mr. B sitting in Maharashtra. Mr. A will upload this sale in his GSTR1. Assume the sale is made in the month of March. Mr. B in the GSTR1 filed by him for the month of March. Such item what Mr. A has included, it will automatically appear in Form GSTR2A of Mr. P immediately. So once Mr. A files sale made to Mr. B in his GSTR1, automatically it appears in Mr. B's Form GSTR2A. Clear? So GSTR2A is nothing but entire return of inward supplies what a specific customer has done during a specific month. And it is a dynamic document. This I'll explain little later. Now let us understand what does this Form GSTR2B means. GSTR2B is nothing but replica of GSTR2A. It has got same thing. When Mr. A files sale to Mr. B in GSTR1, automatically it comes and sits in GSTR2A of Mr. B and GSTR2B of Mr. B. Now, what is the difference? Why there are two different forms in case of one single use? Because GSTR2A also got the same data, 2B also got the same data. There is key difference between these two documents. This GSTR2A is a dynamic document. Now, as we had understood, there which is of. Let us take example. Mr. A sold goods to Mr. B in the month of March. Mr. A would have filed the GST return on 10th April 2020. 10th April. So it will first come on in GST2 and it will come on in GST2A. Suppose let's take a situation where Mr. A has belatedly filed his GSTR return. Suppose let us assume he filed it on 13th April. GST 2B get invoices that were filed on time. GSTR 2A will get details of all invoices, whether they are filed on time or belatedly.
Hello.
Hello.
Huh.
What else,
Hello.
sir? Hello.
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 Om Prakash.
Okay.
Hello. Hello.
Hello, are you able to hear me?
Yeah. Om Prakash. Hello. Can you hear me, Om Prakash?
Yes, I'm able to hear you, sir.
Yeah. Please conclude it by
Mm.
giving examples, and the notes can be shared. Hello.
Sure, sir. So GST 2A, 2B will always get the invoices of their vendors who have filed returns on time. But 2A will get vendor invoices whether they have filed on time or belatedly. Does not matter. So that is the main difference between this GSTR 2B and GSTR 2A. So key understanding between these two returns are necessary because GST law will tell you will be eligible to take input tax credit of such invoices whose vendors have filed their returns on time. Suppose if your vendor is filing the returns belatedly, if he is filing on 13th April, then customer will not be eligible to take the credit for the month of March. So the invoice is dated in the month of March. So that is the key difference GST 2A, 2B, and their relevance in monthly returns. Form GSTR 3B. Form GSTR 3B is nothing but summary of
Hello. Hello.
hello. Are you able to hear me?
Yeah. We are hearing you, sir.
Sorry, sir. Meaning here, network is fluctuating continuously.
Yeah.
So GSTR 3B is nothing but a summary return of all entire sales what you had made during a month, together with what is the eligible input tax credit for a month. Where you will show your output tax, you will show your input tax, net liability will be there, and that amount you need to pay in cash. So due date for filing GSTR 3B for a specific month will be subsequent month 20th. But since India has got close to around 5 crore taxpayers registered under GST law, to mitigate the internet traffic control in GST portal, GST department has divided entire states in.
Hello. Hello. Asif sir. Hello.
Hello?
Hello. Hello.
ಹಲೋ
Hello.
ಅವ್ರದ್ದು ಅನ್ಮ್ಯೂಟ್ ಆಗಿದೆ, ಅನ್ಮ್ಯೂಟ್ ಮಾಡ್ಕೊಳಕ್ ಹೇಳಿ ಸರ್. ಅವ್ರದ್ದು ಪ್ರಾಬ್ಲಮ್ ಇದೆ ಅನ್ಸುತ್ತೆ.
Om Prakash. Hello. Om Prakash. Hello.
ಅವರು ಎಕ್ಸಿಟ್ ಆದ್ರು
Hello.
Hello.
Om Prakash, you can hear me?
Shall I continue, sir?
Yeah. We can conclude
Yes, I'm able to
within
hear
few
you.
minutes, please.
Sure,
Hello?
sir.
Yeah.
Sure.
Please,
So
please.
GSTR 3B is nothing but summary of your output tax, your input tax, and what is the tax paid in cash. And it needs to be filed within 20th of every month. To mitigate the data traffic control GST portal, department has divided entire India into two sets of states. Karnataka is fallen within first set. Therefore, every assessee who is registered within the state of Karnataka need to file their GST returns on or before 20th. Suppose if you are falling in the state of Rajasthan, it is 22nd. Now, this GSTR 2B, 3B, this is entirely written. These returns are relevant for regular registration persons. Who is a regular registered person, casual taxable person, plus non-resident taxable person. But for in case of composition person, they will not be filing any monthly returns. They will be making monthly payment of tax through something called as CLP0L, and they will be filing single yearly return in GSTR 4. It is to be filed once financial year ends on March 2021. Return in form GSTR 4 is to be filed by the composition year on or before 30th April of second financial year. And to further ease the compliance burden on taxpayers, GST specifically introduced a scheme called as quarterly return and monthly payment scheme, wherein it is giving you option the returns on a monthly basis, to file the returns on quarterly basis, but tax to be paid on a monthly basis. So eligible taxpayers who has got an out of up to 5, they can go for this scheme entirely. So this is the summary of returns which a regular registration person will be filing on monthly basis. So in total, he'll be ending up filing 12 GSTR 1 returns, 12 GSTR 3B returns. In addition to this 24 GST returns, there will be additional annual return that needs to be filed on a yearly basis. Nothing but called GSTR 9. That is the annual return which has entire outward supplies what he has made during the specific year, and entire input tax credit what he has taken in a financial year, and what is the actual tax paid input tax credit and what is the tax paid in cash. It is in the entire year summary return, GSTR 9. And whatever mistakes you had made in your GSTR 1 return or 3B return, you can correct in your GSTR 9 return, as long as it relates to your outward supplies. If it is related to input tax credit, you should not correct in GSTR 9. There is additional procedures what this department prescribes to correct those mistakes.
Hello. Om Prakash. Hello.
Yes, sir.
Can
Sorry.
you hear me?
Yeah.
You concluded,
Yes,
sir?
I'll just finish it in few minutes.
Okay.
Sir. Just give me
Please.
10 minutes, I'll finish.
Please.
There are other key concepts which you need to have deeper understanding with respect to input tax credit. Since we discussed that primary intention of government introducing the GST is to allow seamless flow of input tax credit across the supply chain. But practically in GST law, there are certain items on which input tax credit is restricted. Though it is meant to be seamless flow, but there are some hurdles which taxpayers need to forgo while assessing their eligibility for input tax credit. And there is concept of something called as reverse charge mechanism. So this is especially prevalent and brought in from earlier service tax regime, wherein in regular supply of goods or services, service provider will be charging the tax on the tax invoice. He will be collecting it from service recipient. Service provider will pay to the government. But in case of reverse charge mechanism, service provider will not charge the tax to the service recipient. In this reverse charge cases, what happens is service recipient will step into the shoes of service provider. He himself pays the tax directly to the government and he himself claims the input tax credit. This is very much prevalent in case of lawyer services, goods transportation services. If you see any professional fee invoice issued by any lawyer or an advocate, they'll not be charging GST to you. If you are a business entity receiving a lawyer invoice, you will need to step into the of the lawyer, pay the GST to the government, claim the input credit provided other conditions are satisfied. That is nothing but called as concept of reverse charge mechanism. You are stepping into the shoes of service provider, paying tax to the government, correspondingly claiming the input tax credit. So this is very much prevalent in earlier service tax regime. Same thing that has been brought into current GST regime also. Especially this is quite popular in case of services. But in goods also there is reverse charge mechanism. If you, especially in case almonds, if you are purchasing almonds directly from an agriculturist, then agriculturist, since for him it will be supply of agricultural produce on which he will not be levying any tax. But since I am a business entity who is procuring almonds from a agricultural farmer, I will be casted up with the responsibility to pay the tax to the government. Since almonds are my business asset, I will be eligible to take input tax credit also. That is how. So GST law specifically provides the list of services on which tax needs to be paid under reverse charge mechanism. It provides for specific list of goods also where tax needs to be paid under reverse charge mechanism. Now, earlier, as we had discussed, import of goods and export of goods will amount to interstate supply, on which when you are importing the goods, you will be paying this importing the goods, whatever IGST to pay on your bill of entry, that you are not paying it under IGST Act. You are paying it under Customs Act. Always remember that difference. But when you are exporting the goods outside India, you will end up paying tax provided. So exports are all nil rated tax, zero rated supplies. So GST law gives you option of paying the tax, then claiming the refund, or else non-payment of tax on the exports. Supplies to SEZ also. SEZ is a territory specifically demarcated in a specific city. Example, in Bangalore, we have got Gopalan SEZ in Whitefield, another SEZ is there in Electronic City. So this is a place within India itself, but for the purpose of taxation, for the purpose of GST taxation, this specific area will be treated as if it is located outside India, nothing but a foreign country. So it is physically located within India, but for the purpose of GST law, it will be treated as if it is located outside India. So once it is located outside India, it will become an export, which is a zero rated supply on which I need not charge any tax. So there are multiple nuances when a supply to outside India will be treated as export, when it is not treated as export. There are multiple conditions attached to it for it to be qualified as a zero rated supply. Then let us talk something about Gstn Council. So Gstn Council earlier under central excise and VAT regime, respective state government and central government used to make amendments in the law. But here, since central government and state government simultaneously have power to charge the tax, they have constituted something called as GST Council as a common forum between state government and central government. This GST Council is a key governing body for implementation of GST law in India. So it will be constituted under the lead finance minister, in our case, Taranji, and the members will be respective state government finance minister. In Karnataka finance minister will be one of the members of GST Council. So they collectively take decisions for as GST law is concerned. What kind of decisions they will be taking? They'll be taking decisions regarding whether a goods needs to be exempted or not. Recently, if you speak, there was proposal to the government to exempt all raw materials pertaining to manufacture to be exempted. So whenever there is such kind of proposal, Gstn Council takes consideration into such proposals. Only after the approval of Gst Council, then only specific raw materials relating to that COVID drug will be exempted. Unless Gst Council specifically grants exemption, all the goods or services will by default will be taxable. And how do they take the decision? It will be taken through 3/4 majority. Out of entire member, 75% majority should be there. Then only a specific exemption or a notification will be issued. Specific thresholds will be changed. Specific rules will be changed in GST law. Otherwise, if there is no 75% majority, it cannot be passed. It cannot become a law. So this is all about GST Council. It will be headed by Union Finance Minister. All respective state finance minister will be the members in the GST Council. So they will be empowered to make key recommendations on the issues like exemptions, tax rate changes, threshold limit. That's all from my side, sir. Hello?
Hello. Concluded.
Yeah,
Om Prakash?
that's
Yeah.
all, sir.
Okay.
Yeah,
Can
I
I
hope
have
everyone has got some benefit
Yeah. There is
out of this webinar.
definitely it is a very vast subject, and because of the paucity of the time,
I cannot fit in 1 hour.
the questions cannot be asked, or say reply also will take a lot of time. I appreciate the patience of the both speaker as well as the listeners. And may I have the online principal madam and the vice principal sir?
Hyderabad and Bangalore, don't sir.
Hello. Hello. Yeah. Hello. Madam?
Hello? Yes, sir. I am able to hear you.
Hello. You can hear Om Prakash?
Yes, sir. I am able to hear you.
Okay. Sir, Sridhar Swami, sir. Madam? Hello. Hello,
sir. ಇಲ್ಲ
Sir, we can hear you, sir.
Okay. So, at the outset, as I was telling, it's a very vast subject. CA Om Prakash has taken a lot of pains, I can say, to inform the in and outs of GST. Though we are feeling that it is in brief, but definitely it was not in brief. It was definitely exhaustive talk. I thank Om Prakash sir for sparing his valuable time and presented such a informative talk. Thank you very much, sir. Our principal madam, respected Dr. Panita,
Thank you, sir.
was always with us, encouraging in all walks of academic achievements, and she is a leader, deserves all the appreciation. Madam, thank you very much for gracing the occasion. Professor Sridhar Swami, always approachable for any academic tasks, gave very valuable inputs in the beginning itself when we wanted to start this webinar. Thank you very much, sir, for gracing this webinar. I want to mention few names like Madam Shalini, Madam Vijayalakshmi, Girish sir, Asif sir, who have always supported all our technical sessions. Dinesh sir. Then above all, my dear students and participants, it was a very good number, very good response. So this encourages us to conduct many more webinars as far as the technical subjects are concerned. At the end, my appreciation to my UG staff, Deepa Madam, Arun Sir, and my own colleague Sheetal in PG department. Thank you one and all, technical team, and the support given by academicians, not only my college, but also colleges around Bangalore. Outside Bangalore also, we had good number of entries. Once again, I thank you, Om Prakash sir, for being with us for the informative talk.
Thank you.
Thank you, sir. Thank you, sir.
Thank you,
So
sir.
thank you, Om Prakash sir. It was really a very wonderful session. Last time I have taken GST to the students. I have gone through many authors' book, but your session was really informative. It was more than the essence which I have been collected in 6 months. Thank you for the wonderful session, sir. Thank you. Thank you so much.
Thank you for the
Thank you,
feedback.
sir.
Thank you very much. Hasif,
Hello, sir.
can we
And we will end the meeting.
yes.
End
Yeah.
the-
Thank you, everyone. Thanks.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you, sir.